and welcome to this CNBC Africa special. I'm Chris Bishop. Now, it's the word on everybody's lips at the moment, unfortunately, COVID-19. In the finance world, from top to bottom, the pandemic has had a grave effect. As companies count the cost, the question is, how are they dealing with it? Well, we have one of the leaders in the world of business and finance here. With me is Helena Conradie, the CEO of Satrix, a wholly owned subsidiary of Sanlam. Thank you very much, Helena. Just give us an idea of how your company has taken the blow that is COVID-19.
Thanks, Chris. And yes, from a stormy Cape Town, I hope that, fingers crossed, that our connection survives the weather. But yes, how did it affect our business? I think, like for any other business, first and foremost, there's a human element. So we made sure that our entire staff, they could work from home. We're still checking on them every now and then on a constant basis, not only from a connectivity point of view, but also the mental state of mind. And then, very important, your clients. So we communicated with them on a regular basis, providing them with factual information about their portfolios and general guidelines like stay the course. Remember, we are a passive index tracking business, so we don't take active views and make active calls, even or rather more so in an environment like this. We also made sure, and that was a very important point, that the communication respected the sensitivity of the situation. For example, not pushing product or brand at all during that time. And then finally, there is the business element. It's very important that as a business, we're responsible and that we think about the sustainability of our business to serve our clients in tough market conditions like this, but also going for another 20 years. So think of it, if the market loses around 20-30% of its value, our clients' money will bear the brunt of that, but us as a business too, as our income is directly linked to the size of our assets under management and therefore the value of the market. So the aspects within our control that ensured a robust business were not engineered during the crisis. That formed part of a much longer long-term strategy, but it redefined the concept of fluid environment and agile decision-making. I understand the word fully now.
Okay, and just to talk a little bit about Satrix as well, your company. There's a little story behind there. It's something about 20 years ago you started, and you've actually come quite a long way. Just give us an idea of the humble beginnings you've had and what you've endured in the last 20 years in the business.
Thanks, Chris. Yeah, we are the biggest index provider in South Africa. So as you said, wholly owned by Sanlam, which is now above just more than 100 billion assets under management. And that's across a wide range of institutional and retail clients. So as an index pioneer, we introduced the South African investing public to exchange-traded funds in November 2000, so quite a long time ago, when we listed the Satrix 40 ETF on the JSE. And that was just 7 years after the first US ETF. So not too bad for the South African market. Since then, we have expanded our product range, and now it includes 17 unit trusts and 17 ETFs. The China ETF being the 17th one to be listed now. And yes, we were planning several exciting events in 2020, celebrating the 20th anniversary, not only as a business, but also as an ETF industry. But in March, and I know you will understand that, when the world came to a standstill, it felt so terribly inappropriate to celebrate anything, whether face-to-face or digital. But after some necessary reflection as a business, though, we were reminded of our purpose of financial inclusion and our responsibility to provide access to all, and that's very important for us. So today we are in the fortunate position to launch yet another ETF and hope to follow with a couple of more listings further in the year. We even had the first virtual listing of an ETF on the JSE this year. So we are looking forward to the next 20 years as well.
And just talk a little bit more about this ETF listing that you've got coming up. You're calling it in some ways a rand-denominated feeder fund. Just give us an idea, a little bit more of the background about that.
So the index covers it's the Satrix MSCI China ETF. It covers about 85% of the Chinese equity market. And we've opened an IPO on the 1st of July that will run up to the 14th of July. And then we plan to list the ETF on the JSE on the 22nd of July. And it's a rand feeder fund. It basically consists of two components. It's feeder fund and rand denominated. So a feeder fund, in simple terms, is a structure that allows a fund such as the Satrix MSCI China to feed into a much larger parent fund, such as the iShares China UCITS ETF. And all the Satrix global ETFs have an additional feature in that they also rand-denominated funds. So the benefits and the cost of investing in such a rand-denominated feeder fund are twofold. You benefit from the efficiencies that come with size, cost tracking error, all these things, and then you don't have to go through the onerous process of exchange control. So the fee can also be broken down into components. The one that access the underlying iShares fund, and then the additional fee to access the feeder fund structure. It gives you a more convenient and probably also, all costs included, a cheaper way of accessing the biggest emerging markets with your South African rands.
And one of the bigger markets you're talking about that you're going into is China, which too has had its problems in the last 6 months, the same with the rest of the world in terms of this COVID-19. Well, why are you trying China, and why are you trying it now?
Very good question. I think we've asked that ourselves as well. But the short answer would probably be that it's just too big to ignore. BlackRock did some very interesting research on mega trends in the world, and one of them being the shift in economic power from west to east. And there's a lot of writing about that and discussions, arguments. We also hosted the webinar with Wei Li from BlackRock last week, discussing the significance of China as an investment opportunity. And I can share with you some of the numbers that some of you probably know, but I think most of us just forget when it comes to investing. So in 2019, China's population stood at 1.4 billion, which makes it the largest of any country in the world. And it's approximately 19% of the world's population. China also has the second largest bond and stock market in the world, and it has the second largest economy in the world. And analysts are now predicting, where they said 10 years, now they're predicting that the Chinese economy will be the largest in the world in the next 5 to 7 years. And listen to this one. This is a very impressive number for me. The forecasted contribution of the Chinese economy to the 2019 world GDP growth is 33% relative to that of the USA at 14%. So there's no doubt that the engine of global growth is shifting towards China. And the surprising factor here is that foreign ownership stands at only 3%. As historically, it's been quite a huge challenge to access the Chinese market. So the good news is that investor regulations have been revised over the last decade or more, making it much more easier and appealing for investors to invest. And this has seen quite a couple of changes. China iShares in the MSCI emerging market indices over the couple of years now, slowly starting to breach that gap between the relative size of the economy and then the allocation in the indices. So that's good news, and I think that explains why I started off by saying it's an investment opportunity you simply can't afford to ignore.
And I'm sure a lot of investors out there watching are perhaps looking at what you're trying to do with exchange-traded funds. A lot of people may be asking the question, why an ETF? Why not just invest directly in Chinese companies?
Yeah, so one of the most important concepts in investing is diversification. And in simple terms, it means that you lower the risk of your portfolio by spreading your instruments across various things, financial instruments, countries, asset classes, industries, anything that you can think of. And in the case of China, diversification probably plays an even bigger role. China has often been criticized for selective disclosures on various issues, data, accounting policies that differs from the West, and so on. And in short, I think it's fair to say that there is some sort of a trust deficit when it comes to China. And the uncertainty around stock-specific information can lead to a much higher risk scenario when you choose the stock picking route. Where an ETF tracking a more diversified, broad-based index, on the other hand, is a way of accessing the Chinese market with less risk and definitely more peace of mind. And then there is a very important point we can easily forget. In addition to that, you also benefit from a reputable index provider such as the MSCI that monitor the commitment from the Chinese regulators to improve market accessibility. A good example of this is the recent weight increase of A shares across all emerging market MSCI indices, in effect acknowledging the revised and improved foreign investor regulations. And then I almost forgot to mention the most obvious benefit, and that's the one of cost. Emerging markets are by definition faced with less efficient and more costly trading environments that will be amplified if you invest directly in Chinese companies. So a diversified ETF investment can soften that blow by benefiting from scale and other size-related efficiencies. So in summary, why an ETF? Cost, diversification, and monitoring from a reputable index provider. So all in all, I would say this is actually one of the more easier choices to make when investing in China.
And what about the competition in your field? What other ETFs are there around with exposure to China right now?
There are other ETFs available. There's no China ETF. And let me explain the difference, and I'll get into the detail of the different indices. I must admit that Chinese equity market is not as easy to understand at first. It took us a while to get a grip on the equity market and to understand what people refer to as the alphabet of shares. And I can briefly touch on that before discussing different index choices. Depending on factors such as the exchange on which the shares are listed, as well as currency and investor accessibility, all Chinese shares are classified either as, and concentrate on this one, A shares, B shares, H, rare chips, P chips, and overseas listed shares. So it is a mouthful. And A shares have been one of the more debated classifications, having historically been only available for purchase by mainland citizens due to China's restrictions on foreign investment. But since 2003, they have been revised, the regulations, and that has led to the gradual increase of A shares in the MSCI. So the MSCI China Index, the one that we're tracking in this new ETF, is a flagship index that aims to represent the performance of large and mid of all the mentioned shares. So including a partial component of China A shares. So it is quite comprehensive. It is therefore the most inclusive index compared to any other niche alternative that you can get, like a MSCI China A, which covers only the universe of A shares. It has 704 constituents, so quite a lot, and it covers more than 85% of the China equity universe. Another alternative would be to invest in the MSCI Emerging Market Index with 39 exposure, so 39% exposure to China. But it depends completely on your appetite for China. You might choose a more diversified play on emerging markets in total, or given all the arguments discussed earlier, you might want to go boots and all to fully participate in China. At least now you have a choice.
Well, thank you very much indeed with your foray into China. Best of luck with that. That was Helena Conradie, the CEO of Satrix, a wholly owned subsidiary of Sanlam. I'm afraid that's all we've got time for on this CNBC Africa special. From me, Chris Bishop, and the team, it's goodbye.